What if Wall Street never closed? What if a treasury bond, a share of stock, a private credit investment, or even ownership in a commercial building could move across financial networks almost as easily as an email? What if transactions that currently pass through multiple institutions, databases, reconciliation systems could be executed, recorded, and settled through shared digital infrastructure? That is the promise of tokenization. But before anybody starts shouting that everything is going on chain, we need to ask the questions Wall Street advertisements often leave unanswered. What does the token actually represent? Who holds the underlying asset? Where is the official ownership record? What legal rights does the investor receive? Can the token really be traded around the clock? And does tokenizing an illiquid investment actually create liquidity or merely place an illiquid investment inside a digital wrapper? Because tokenization may change how an asset travels, it does not automatically change what the asset is, what it is worth, or how much risk it carries. Today, Wall Street goes on chain. Welcome to the Unbearably Bullish podcast, the official podcast of the Bull You Can't Bear. I am your host, Donald Johns, and welcome to Wall Street Wednesday, where we get over the hump by separating market innovation from market imagination. Today's episode, Wall Street goes on-chain, the tokenization of everything. For years, blockchain technology was discussed primarily through Bitcoin, cryptocurrencies, and speculative digital assets, but the conversation is changing. Major financial institutions are increasingly examining whether blockchain and distributed ledger technology can improve infrastructure supporting traditional financial assets. We're talking about Treasury securities, stocks and bonds, money market funds, private credit, investment funds, collateral, real estate interest, and potentially many other financial claims. In January 2026, the SEC staff described a tokenized security as a security represented in crypto asset form when ownership records are maintained at least partly through one or more crypto networks. That definition contains the key word security. A tokenized stock is still connected to a security. A tokenized bond is still connected to debt. A tokenized fund still has investments, expenses, and risks. The technology may change the record keeping and movement of the asset. It does not wave a digital wand and eliminate securities laws, economic risk, or investor responsibility. That brings us to today's first bull bite. Tokenization may change the wrapper, the rails, and the speed, but it does not magically change the underlying economics. Let's simplify this. Tokenization is the process of creating a digital representation of an asset, ownership interest, or financial entitlement on a blockchain or another form of distributed ledger. Imagine a commercial building worth $20 million. Traditionally, ownership might be recorded through a corporate document, partnership interests, custodial records, and separate databases. A tokenized structure could digitally represent defined ownership interests or economic rights connected to that investment, but the token is not necessarily the building. It represents whether legal and economic rights the governing documents give its holder. That distinction is everything. The same principle applies to securities. A token could represent a share issued directly by a company, an interest in an investment fund, a security entitlement maintained through a custodian, or a third-party instrument designed to track another security. Those structures may look similar on a phone screen while providing very different legal rights. The SEC has identified two broad models. In the first, the issuer or someone acting as the issuer's behalf tokenizes the security. In the second, an unaffiliated third party creates a tokenized instrument connected to a security or entitlement it holds. In plain English, one token may be the issuer's official digital security. Another may be a third party's promise or wrapper connected to an underlying security. They are not automatically equivalent. Before asking what a token might earn, ask, what do I legally own? Here is a framework audiences can use to evaluate tokenized assets. The underlying asset. What sits beneath the token? Is it a treasury security, a stock, bond, fund, loan, real estate interest, commodity, or merely a contractual promise tied to another asset? Layer 2, the legal wrapper. What legal rights does the holder receive? Ownership, a security entitlement, a beneficial interest, a debt claim, a contractual right to payment. Technology cannot repair weak legal documentation. Layer 3, the custodian and ownership record. Who holds the underlying asset? Who maintains the official ownership record? Is the blockchain the authoritative record, or does another database control? What happens if those records disagree? Layer 4, the blockchain and smart contracts. Which network records the token? Who can modify the smart contract? Can transactions be frozen or reversed? How are mistakes, hacks, lost credentials, and network disruptions handled? Layer 5, the marketplace. Where can the token be bought or sold? Who is permitted to trade it? Is there meaningful volume? Is pricing transparent? And can the token be converted back into the traditional asset or redeemed for cash? Remember these 5 layers: asset, rights, custody, technology, market. If you do not understand all 5, you do not yet understand the investment. Why does Wall Street care about this technology? Because today's capital markets contain enormous amounts of infrastructure: brokers, exchanges, clearinghouses, custodians, transfer agents, payment systems, corporate action processors, and multiple records that must be checked and reconciled. Tokenization could potentially allow an asset and its payment to move across connected digital infrastructure. That creates the possibility of delivery versus payment, where ownership and payment transfer together, reducing the risk that one side performs while the other does not. It may also support faster settlement, more mobile collateral, automated distributions, programmable compliance, improved record synchronization, potentially longer operating hours, and greater access to certain investments through fractional ownership. But notice my language: could, may, potentially. A blockchain does not automatically guarantee instant settlement, lower cost, or continuous trading. Banks still need funding, investors still need cash, regulated institutions still need compliance, markets still need buyers and sellers, and separate networks still need to communicate with one another. A fast road is useful only when the vehicles, laws, and destinations are connected. Why should an ordinary investor care about financial market plumbing? Because market infrastructure eventually affects how quickly money becomes available, which investments can be accessed, how ownership is verified, how dividends and distributions are paid, how collateral is moved, when markets operate, and potentially how much financial intermediation costs. Consider a private market investment that traditionally requires extensive paperwork, manual subscriptions, and limited transferability. Tokenization could potentially automate parts of the onboarding, record keeping, and servicing process. It might also allow ownership interest to be divided into smaller units. But fractional ownership should not be confused with liquidity. You can cut a building into 1 million digital pieces. If nobody wants to buy those pieces, or if transfers are legally restricted, the investment remains illiquid. Digitizing the door does not guarantee an exit. That is where Main Street must be careful. Accessibility does not equal suitability. Speed does not equal safety. And smaller minimum investment does not mean smaller percentage risk. Let's do my bull versus bear, revolution or digital repackaging. The bull says tokenization could modernize decades of old financial infrastructure. It could improve asset mobility, reduce reconciliation, automate corporate actions, make collateral more efficient, support fractional access, and create new connections between traditional and digital markets. The bull sees a future where assets, payments, and compliance instructions all move together. The bear says the financial system may be replacing one complicated structure with another. Different blockchains can fragment liquidity. Smart contracts can contain vulnerabilities. Wallet credentials can be lost or stolen. Third-party tokens may confuse investors about what they own. Around-the-clock trading that could create thinner overnight markets rather than better markets. And instant settlement may require investors to pre-fund every transaction, potentially reducing the flexibility provided by current market structures. The bear also asks, who is responsible when the code fails? Reverses fraudulent transaction. What happens in bankruptcy? Which jurisdictions laws apply? And what happens when the blockchain record conflicts with the custodian's official books? The bull sees programmable finance, the bear sees programmable complexity. The truth will depend on the structure, regulation, and investor protections behind each token. Tokenization is no longer limited to presentations and white papers. The Deposit Trust Company is one of the central institutions supporting U.S. securities markets. Its parent organization, DTCC, reported that DTC custodies more than $114 trillion in assets. In July 2026, DTCC announced that more than 30 traditional and digital market firms participated in controlled transactions using DTC tokenized assets. The tested workflows included collateral pledges, securities lending, treasury and repo transactions, equity transactions, token transfers, and margin-related processes. That does not mean the entire stock market has moved on the chain. It means established market institutions are testing whether tokenized infrastructure can operate with institutional controls, legal protections, and existing market resilience. That is an important distinction. This is not an overnight replacement. It is infrastructure evolution. Here are 6 developments to watch. 1. Tokenized treasuries. Government securities may become an important bridge between traditional finance and blockchain-based markets. 2. Tokenized money market and investment funds. These products could provide yield-bearing assets that move through digital financial networks. 3. Tokenized collateral. The ability to move eligible collateral more efficiently may become one of the most valuable institutional applications. 4. Tokenized stocks and bonds. Watch how exchanges, custodians, transfer agents, and regulators define ownership and trading rights. 5. Interoperability. Can assets move safely between different blockchains and traditional systems, or will markets become fragmented digital islands? 6. Investor protection. Watch custody, disclosures, cybersecurity, market surveillance, redemption rights, and bankruptcy treatment. The winning technology may not simply be the fastest blockchain, it may be the system that creates the greatest combination of trust, legal clarity, liquidity. Here's today's Wall Street Wednesday challenge. Choose one tokenized investment and answer these 7 questions. What is the underlying asset? Who issued the token? Who holds the underlying asset? What legal rights does the token provide? Where is the official ownership record? Where can it be traded or redeemed? And what happens if the issuer, custodian, platform, or blockchain fails? If the marketing material cannot clearly answer those questions, do not let the word tokenized substitute for due diligence. We're going to do my bull's bottom line. Wall Street going on chain does not necessarily mean Wall Street is disappearing. Banks may still provide money. Broker dealers may still facilitate transactions, custodians may still protect assets, and transfer agents may still maintain records. Regulators may still enforce securities laws. What changes is the infrastructure connecting them. Tokenization's greatest potential may not be turning every investment into a cryptocurrency. It may be making traditional assets more programmable, portable, and operationally efficient, but the technology must support the asset, not distract from it. The blockchain cannot improve a bad business. A digital token cannot guarantee a fair valuation. Fractional ownership cannot manufacture buyers, and faster settlement cannot eliminate investment risk. So do not ask only, is this asset tokenized? Ask, what do I own? What rights do I have? Who stands behind it? Where can I sell it? And what's happening when something goes wrong? That is how you think like an investor, not like the crowd. Thank you for joining me today on Wall Street Wednesday for the Unbearably Bullish podcast. Always remember, we focus on strong markets, stronger mindset, unlimited opportunity. Let's follow the herd and always stay unbearably bullish. I'm your host, Donald Johns, and until the next time, have a successful, productive, and a profitable day. We love all of you.